Ladies and gentlemen, good day and welcome to Electronics Mart India Q2 and H1FY25 earnings conference call. As a reminder, all participants' line will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Karan Bajaj, CEO of Electronics Mart India Limited. Thank you, and over to you, sir.
Thank you. Good evening and a very warm welcome to everybody present on the call. Along with me, I have Mr. ProInvestor Devarakonda, our Chief Financial Officer. We have uploaded our results and investor presentations for the quarter and half-yearly end FY25 on the stock exchange and the company's website. Hope everyone had a chance to go through the same. In H1 FY25, our revenue stood at rupees 3361 crores, reflecting a growth of 13% year-on-year. Our EBITDA stood at 238 crores against 227 crores, also growing by 5% year-on-year, with EBITDA margins at 7.1%. In Q2, heavy rains in South India have impacted demand, but we anticipated that the consumer spend will rebound as conditions normalize. Additionally, Q2 tends to be a softer period for electronic retailer, and this year we face additional challenges as well. As mentioned, the South Cluster, especially Hyderabad and Vijayawada, our key markets experienced heavy rainfalls, causing reduced footfalls and weakening demand. Air conditioner sales were impacted by the extreme monsoon. However, the category also demonstrated resilience as a consistent performer, maintaining steady sales for the first half of the year and showing a growth of 46% in Q2 FY25, a growth of 24% Y-on-Y. Large appliances contribute to maintain their spot as the largest revenue contributor. For H1 FY25, large appliances contributed 46% to the revenue, mobile phones contributed 42%, and small appliances, IT and other categories contributed 12% collectively. In the first half of FY25, we continue to expand our store footprint. We have opened 18 new stores. Our store count as of September 2024 stood at a total of 177 stores, out of which 164 stores are the multi-brand stores, 13 are exclusive brand outlets. We are present in 70 cities across 6 states currently. In NCR region, we have reached up to 25 stores. We remain confident in our full year guidance of adding 25 to 30 new stores. Going forward, our strategy would be to further strengthen our presence in Delhi NCR cluster and the existing market at the same time. As we prepare for the upcoming season, we expect consumer behavior to evolve with an increased focus on premium electronics. Moving towards working capital, we typically see an increase in inventory during the September end in preparation for the festive period. As of September 24, our inventory days stood at 62. Going forward, our strategy will be to focus on optimizing inventory levels to drive higher cash flow conversions, which will further strengthen our balance sheet. Same-store growth for H1 of FY25 came at 6%. And I'm also pleased to report that our North cluster has remained EBITDA positive for the 3 consecutive quarters. We expect this improving going ahead. Our goal is to steadily improve margins in the North cluster, aligning them with the performance of the South cluster. As India continues to move up the ladder in terms of GDP per capita growth, the increased disposable income is fueling great demands for premium consumer durables and electronics such as air conditioners and washing machines, refrigerators. With increased purchasing power, more households can afford these products, transitioning from aspirational purchase to necessities in many urban and semi-urban areas. Additionally, a growing middle-class population, coupled with improved access to financing options and innovative product offering, is expected to significantly boost sales in these 3 categories, driving further growth going forward. At EMI, we strategically partner with top brands and offer a wide range of products, positioning us to serve a broader base of customers. As India's GDP per capita continues to rise, we have been witnessing increased demand for high-quality consumer durables, with a noticeable shift towards the top 5 brands in key segments. Our comprehensive product selection enables us to meet this growth demand. While our focus on trusted brand drives customer satisfaction, this powerful combination of strong brand partnership and broad product offering position us for significant growth going forward. With this, I request Mr. ProInvestor Devarakonda, our CFO, to update you on the financial performance. Thank you all.
Thank you, sir. Good evening and warm welcome to all the participants. Let me begin with the Q2 FY25 financial overview. Our revenues for the quarter stood at 1,386 crores as against 1,303 crores in Q2FY24, with a growth of 6% year-on-year. EBITDA for Q2FY25 stood at 84 crores as against 97 crores, a degrowth of 13% year-on-year. EBITDA margins for Q2FY25 stood at 6.1% as compared to 7.4% in Q2FY24. Pre-Ind AS EBITDA for Q2FY25 stood at 54 crores with a margin of 3.9%. PAT for Q2FY25 stood at 25 crores as against 37 crores, a degrowth of 34% year-on-year. Now, moving on to the H1 FY25. Our revenues for H1 FY25 stood at 3,361 crores as against 2,987 crores in H1 FY24, a growth of 13% year-on-year. EBITDA for H1 FY25 stood at 238 crores as against 227 crores, a growth of 5% year-on-year. EBITDA margin for H1 FY25 stood at 7.1% as compared to 7.6% in H1 FY24. Pre-Ind AS EBITDA for H1 FY25 stood at 178 crores with a margin of 5.3%. Same-store sales growth for H1 FY25 was 6%. PAT for H1 FY25 stood at 97 crores as against 98 crores, a decline of 10%, which is marginal. For H1 FY25, same SSG, I would say, SSG rate stood at 6%. ROC and ROE on an annualized basis for H1 FY25 stood at 17.8% and 13.2% respectively. The working capital days as on 30th September 24 stood at 66 days. The gross debt to net debt time to equity stood at 0.4x, and our net debt to EBITDA stood at 1.09x. Pre-Ind AS cash flow from operations stood at 260 crores. With this brief presentation, may I now open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have first question from the line of Devanshu Bansal from Emkay Global. Please go ahead.
Yes, sir. Hi. Thanks for taking my question. First question, Karan, is there has been some growth moderation in Q2 after a very good Q1. You alluded to some sort of operating challenges for that. I just wanted to check, has there been some postponement of sales into the current festive? So if you could just help us understand how have been the trends so far in Q3?
Okay. Hi, Devanshu. So, Devanshu, so definitely if you see historically also Q2 is always a lower quarter compared to Q1 and Q3. So Q3 becoming a festive period quarter where Diwali and Dussehra is there versus no big festival, no big product launches, during the Q2. So that definitely impacts. And then, moderate rainfall versus a heavy rainfall, which we experience this time in a lot of geographies that we are present in, definitely impacts a lot of footfall. So that is not like the only reason, but one of the key reasons for the lower growth, I would say. And definitely, what is happening is that trends over the years, whereas the festive period becomes like a go-to market for consumers to come and buy because there are heavy discounts, cashbacks, and offerings by all retailers and companies. So definitely, yes, somebody buying a product during the last week of September usually would postpone it by a week or so, because this year, if you see, we started the festival on the 2nd of October, with the first Navratri on the 3rd October. So that definitely that kind of postponed buying is always there. So Q3 is being good, no doubt on that. The festive period was good, so no struggles in the festive period. But then how the Q3 pans out during November and December is majorly important, because usually you would see a little dip in sales post the festive period once all the brands and cashback offers would get reduced starting this week. So then you would see that impact coming in there as well. But overall, no complaints. So there has always been a quarter where there is one of a quarter where, the numbers go down a little bit because of a lot of external factors. But as expected, Q1 did well. As expected, Diwali did well. So that is in line with, the numbers that we would expect. And then you have a lot of cost involved in running operations, especially for new stores that get launched within that quarter or new stores that are getting ready. So there's a lot of capex involved, a lot of manpower already onboarded. So all of those things definitely bring down the margins a little bit. But all is under control and in alignment of what we had planned for the new store opening expansion season, for the Diwali season that we had planned, because we had to, from inventory perspective also, we had to buy out a lot of stocks in the last week of September, and that was the time when iPhone 16 also got launched. So there were a lot of reasons that we had to increase our inventory. That's why you would say 62 days of inventory on the books, because first week of October itself would be the beginning of the season starting from Navratri. So we had to get all the stocks ready and in our warehouses. So you would see that cost also going up a little bit here.
Understood. Karan, just qualitatively, if you could indicate between Navratri and Diwali, which is a 30-day period, like to like this year versus last year, how have been the trends? Any qualitative or quantitative number that you can throw here?
So Navratri and Diwali, obviously we will not be able to, give you an exact number on that, but the flavor has been good, all positive. So it has been in line with what we saw historically on the 15th of August this year, what we saw during other big festival days. So Navratri and Diwali and Dussehra, Dhanteras have all panned out to our expectation. So there is no complaints there. In fact, few regions that you saw being flat, like for example the Hyderabad cluster being flat during Q2, has also performed really well during Diwali. Though definitely it is not that high of a growth from that region, but the base being very high, we still saw good growth coming in from that region as well.
Understood. Lastly, Karan, I wanted to check, the company has done a good job with no major increase in working capital despite 18 new store additions in first half. Typically, in the industry, we see peak inventory levels at year end, right? Because of all those air conditioners stocking that we have to do to sort of fulfill the season's demand. So I just wanted to check, what is your expectation on debt level for the company at year end? Right? So we may have to sort of invest in the inventory. So any thoughts on that?
Just to actually jiggle out your question a little further. So more than year end, on 31st March, definitely you will see, higher, not higher debt levels, but higher inventory levels standing out because of the cooler, AC and refrigerator category, being in demand during that particular season of summer. But if I give a comparative to our Q3 numbers at the end, would be, you would see a much drastic difference in terms of the number of inventory days and debt levels both panning out on 31st of December. So, because it has already been, so whatever inventory we had planned out for Diwali has already been sold. So we're not carrying a lot of inventory currently with us, except few categories which is a part of the plan that we have, where we have additional offers. So we usually would end up buying a little more stocks for this quarter as well, where it will support us on some margins. So apart from that, everything is in line, and the debt level also would be in line. It will not be so historically what we would see right now comparatively. It will keep on going down, not drastically, but a little bit going forward as well.
Okay, so even after these 12-13 more additions in H2, you do not see any significant increases in debt levels, right? Okay.
Yes.
Understood.
Yes.
Fair enough. Yeah. Thank you. Thanks for taking the question.
Thank you, Johnson.
Thank you very much. Participants, if you wish to ask a question, you may press star and 1. We have a question from the line of Praful Rai from Arjav Partners. Please go ahead.
Yeah, I just have one question. We have guided for a 20% kind of a revenue growth for the year, and that is what the general guidance we have been giving. Do you think we'll be able to meet that kind of a guidance given the sales in the festive period?
Hi, Praful. So, Praful, yeah, we were looking at a 15 to 18% growth. That is what we've been commenting out in the market every time we meet someone. So, 15 to 18% is what we comfortably achieve. That is not a problem.
So should be able to make up for the sort of a low growth in Q2 in the rest half of the year, right?
Yeah. So if you look at the numbers where, say, what guidance we have given out or what numbers we would pan out, we are more or less at half 50% mark of it anyways, you know. So we don't worried about how, what is being behind us versus what is going to come in future. So Diwali went well, things are under control. So now the only delta that you would see in a higher number would be by the end of Q4, where if summer sets in early, say as early as second or third week of March, then we'll have that additional, say, 150 odd crores of sales happening during the last 10-15 days of summer. Apart from that, you will not see a major change. So there will be a delta of 150 crores, not more than that.
And secondly, on the margin side, when we started rolling out in NCR region, we saw some kind of a margin dip because of expenses involved. But now looks like we are stabilizing there. So will you see some kind of operating leverage playing out for us?
So Prabhu, just to answer your question, what will happen is right now we're at 25 stores. We're adding up 6 stores in the next 40 days. So what will happen is, because of the denominator being lower, additional 7-8 stores together adding up in the next couple of months or a month or so, it will automatically bring down the margin a little bit. But we are looking at that region to stabilize. We have to give it a little more time, but we are looking at that region to give us a similar kind of margin, at least for the existing stores or the 7-8 stores that we opened 2 years back. So those kinds of stores will start giving us almost a similar number in the next 12 months or so. So we are looking at that region growing in terms of giving us a leverage on our balance sheet in the next 12-14 months, nothing before that.
So you will start seeing some kind of inch up happening there in terms of the operating profits.
Absolutely. So we're not looking at a loss there right now. So that is what is more alarming, if that would be the case. So right now we're not looking at anything for the last 3 quarters going forward. Even this quarter did well. So looking at that number, we are quite confident that we don't need to worry about that region. And just stabilize it from here on.
Okay, thanks a lot. I think this is what I have to ask. Yeah, thanks.
Thank you very much. Participants, we would like to remind you that to ask a question, you may press star and 1. We have a question from the line of Omkar Chitnis from Trade Brains Private Limited. Please go ahead.
Thank you for giving the opportunity. Sir, I have a couple of questions. From last 2 years, I am observing that from Q1 FY23, net sales per store is reducing. In Q1 FY23, the net sales per store was 12 crores. At presently, 7.2 crores. Is there any rectification action we are taking for this?
Yeah. So Omkar, actually you pointed out the right question where, I think the right comparison would be that what are the additions of stores that we add up on square feet that we add up in that particular quarter or that year. So last 2 years, as you said correctly, we've been expanding drastically and we've added newer clusters and we've added new space at a much higher rate than what we've been doing in the previous years or quarters. So that is why you would see that the average ticket size or the revenue per square foot would be little lower compared to our previous quarters. But if you look at the actual number of the sales generated from the existing outlets that we are there, or the mature stores or the stores getting matured, which we opened in the last 12 to 14 months, those stores have been doing really well. And then we see that number, comparative number. But in the presentation and in the public market, we would actually have out a total store count versus the average per square foot revenue or the revenue per store generated. So that is why, because of the number of store count increases drastically, you would see a drop in the productivity per store. But we can give you a complete breakup of historical data as well, whereas you can compare it at a much detailed level where you will understand that the clusters that we've opened, stores which are matured or 12 months or 14 months older stores, have also grown by 18-20%.
Okay, understood. So as you mentioned, there are 177 stores as of Q2 FY25. How many stores are in profitable as of now, sir?
Sorry, how many stores are in profit?
Yes.
Omkarji, so the thing is that, 7 stores, like we opened last quarter, out of which you can say that these stores will take another, also these 7 stores will be operational profitable because they are in the existing cluster itself. So these stores are all profitable. Only I would say one store that we estimated for it not to be profitable is one in Hyderabad, one in the mall, which we would expecting it to go into red in the next 12-14 months. So that is why we minded up that store. That is the only store that we've shut this financial year till date. And I would not say that any store is in red. Operational break-even सारे store का होता है. But the only thing that if you open a store last month or in the last 45 days, it takes up a little time for it to get mature, right? Apart from that, no other store in any region that we operate are in red. Only how we would differ it is that few stores might make a blended EBITDA of say store level EBITDA of say 10%, some would be at 11.5%, some would be at 6.5%. So that is how the math would work out. But Delhi NCR region on the whole, if you see, is a newer region where the EBITDA margin would be much lower compared to our southern cluster.
Thank you so much, sir. I believe the line for the participant got disconnected.
Okay.
Before we proceed with the next question, we would like to inform the participants you may press star and 1 to ask a question. We have a question from the line of Drashti from ThinkWise. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, can you help us understand what is the unit economics of the older stores that we have, and how do we think about the profitability of those stores? What would be the growth of those stores? What would be the wage inflation and OPEX growth in those stores? And of the 177 stores that we have, what proportion would be the older stores, and how are we thinking about the newer stores? Thanks.
So Drashti, how it would work out is that we would look at a square foot average of a 10,000 square feet in the mature stores. So that is an average square foot that you take as a benchmark. And then, so these stores would, for the existing cluster, because most of the mature stores would be in Hyderabad alone, and few of them in the Telangana market and Andhra Pradesh, in Vijayawada, Visakhapatnam, and Tirupati. So these were the older stores that we opened, say, 5-7 years back. So these kind of stores, which are in a cluster where they're already mature to, say, 50 crores, 70 crores, 100 crores, these kind of stores would grow at a much lower pace compared to the newer stores that we opened the last 24 or 36 months. So the newer store that we would open recently would pan out to grow at, say, 18, 20, 30%, depending on the lineage of that store. But the mature stores, especially in the clusters where we're cannibalized by opening a newer store nearby, those stores would look at a growth rate of 1 or 2, 3%, not more than that, until unless there is a new technology change or new addition on the floor for new technology products. But these stores are all matured at, say, 70, 80 crores on an average. So that way, the EBITDA margin for these particular stores would look at, say, 9-10% kind of a number. And properties that we own, where there is no cost of rental for the mature store, then you have to look at 1-1.5% higher than the rented out stores. That is how the differentiation would be. The newer stores would start panning out in the southern cluster, would start panning out at 5-6% initially for the year one, and then eventually stabilize at 6-8% going forward in terms of the store level EBITDA margin. And the growth rate year 1, year 2, year 3 would pan out to at say 50%, depending on for the year 1, depending on what quarter or what month we open. Year 2 would stabilize at say 30-35%. Year 3 then would be at around 20-25%, and then from there on year 5 onward it would be at 7-10% kind of a number, because these pockets are in tier 3, tier 4 towns. You will not see a big cluster of markets and a big growth coming up there at the same time. So it is all organic there. Whereas in terms of the mature stores today, out of 177 stores, we could count around 80 stores being under 24 months, and the rest of the stores, especially the MBO stores, are all matured over 24 months.
So is it fair to say that it takes typically 2 years for a store to mature, and after that the growth expected in those stores would be just 1-2%?
No. So it depends. So like, for example, if we cannibalize the store, so for example, if I have a store in Hyderabad which is 10 years old, which does say 100 odd crores, and we cannibalize the store because it can't take up more people than 100 crores in turnover, for big days, there's a lot of spillage and all of parking issues or a lot of those things. So when we cannibalize or we see that, customers can't travel 3 or 4 kilometers, or, we need to open one more store in a similar cluster, then that's when we cannibalize. And once we cannibalize that store, then the growth rate is single digit there. But in case there's a market where the growth is, with the store is in 70-80 crores and still growing at 10%, so that is a different store. So when we don't cannibalize it, there you'll see higher growth even for the mature store. But for the stores which are over 100 crores and all, we usually would open few stores in the same periphery because there is a lot of spillage or there is a lot of leakage during big days, weekends, summer, Diwali, Dussehra, Dhanteras. So that is how we would do. Those stores will look at a number of 1-2% kind of a thing, which are 10-15-year-old stores.
Understood. So why I'm asking this is because what I've seen is in the value growth that we've seen in our stores has not been more than 2-3%, which is why I'm trying to understand how the matured stores grow. Because volume growth, I assume, would be hardly anything in those matured stores.
So if I give you an example for quarter 2, if you've seen 100 crore growth on quarter versus quarter, that is quarter 2 last year versus quarter 2 this year, out of the 100 crores, the majority of the growth has come in, say the mature stores which are over 3 or 5 years have contributed to, a flattish number, say a 0.5% or 1% kind of a growth rate. But whereas the stores which we opened last 24 months have contributed to almost 80% of that growth, whereas the 8 stores that we opened up in that quarter has contributed to a total value of almost 15 crore rupees approximately out of the 100 crore stores.
Understood, sir. So in these matured stores, wage inflation would be 7-8%. So is it fair to say that these are EBITDA margin declining stores perennially, or how do you think about that?
Yeah, so in fact, our industry, if you look at a lot of the major categories that we deal with or the brands that we deal with, we don't see a price increase. In fact, price for air conditioners have gone down by 2 or 3%, air coolers have gone down, kitchen appliances have gone down, refrigerators, television, washing machine, the average pricing has gone down by 7-8% actually, not increased, it's the other way around. Only apart from, 1 or 2 brands. In fact, iPhone this year also got launched at a lower price than last year. So if you actually see the pricing for iPhone 16 Pro Max, which got launched in the last week of September, the pricing for the high-end models are down by 10,000 rupees, so compared to last year. So if you see, instead of inflation, there is a deflation of pricing, especially for high-end premium products, where like a 75-inch or an 85-inch, which was priced at 2.5-3 lakh rupees, is at affordable at a price of 150, 175 this year.
No, sir, I was asking about the employee cost increase, the wage inflation.
Employee cost?
Yeah.
So if you see, if you see this quarter as well, that was a major hit that we had to take in our expense, the rental and the expense on manpower, housekeeping and security all put together. We would see a higher cost involved there. So that is always there. So you would always look at a 5% or a 4% kind of an increase in that cost every year. So you can't avoid that.
Understood. And so in your opening remarks, you mentioned that you've seen a noticeable shift towards top 5 brands. So what would be the contribution currently? I think it was 65% somewhere last year. So what is the contribution of top 5 brands this first half?
Yes. So it would be around a similar range, but acceptance of these brands is going up day by day. So even in our tier 3-4 towns, the acceptance of, say, an Apple device or a Samsung television, so the customers even in the entry level, say a direct cool refrigerator or, a semi-automatic washing machine, air conditioner. So now people are preferring for bigger brands and better brands across categories.
Despite so many newer brands coming in, people are preferring the top 5 brands, is what you're trying to say?
Yes.
Thank you so much, sir. This was helpful.
Thank you. We have next question from the line of Virat Shah from Shah Investor. Please go ahead with your question.
Hi, sir. I just had one question. So within which segment we have seen outperformance in Q2? Any uptake in washing machine category because of rainy season?
So usually you would expect that the monsoon would bring us higher sales in dryers and washing machine, but this year it was more or less flattish or little negative, I would say, down by 1%. Even refrigerators and washing machine, both categories were negative this quarter. So that was a surprise for us. But then a lot of reasons for that. The whole industry was actually down by a higher number in that category. But then, especially in Hyderabad, where our base was quite high for washing machine as a category, there we saw almost, 1% dip in, from the numbers in last year.
Okay, understood. Thank you, sir.
Thank you.
Thank you very much. Before we proceed with next question, we would like to remind participants that you may press star and 1 to ask a question. Next question is from the line of Amish Kanani from Knowise Investment Managers. Please go ahead.
Yeah, hi. Sir, if you can give us some flavor, of the growth, on one which is a slow growth in the quarter and, slightly better growth post, the quarter in the Diwali, season, within, mobile, large appliances versus small appliances. Which one was a slowing area in slow growth area in Q2, and which is the kind of, say, area or category which is picked up post Q2 as, this Diwali season is looking fine for us. Thanks.
Right. So Amitji, not only Q2, but last 6-8 months, usually the growth that we've seen in the last 5 years, majority has come in from mobile phone as a category, being the highest growth category individually. वहाँ पर थोड़ा slow down है mobile which is growing at 20-25% in the last 5 years. Now we see a 10, 12, 14% kind of a growth only. So that has reduced a little bit. But apart from that, large appliances have been a little flat. Televisions have seen decent growth. Laptops have seen a decent growth. Kitchen appliances have seen a decent growth. Other categories have seen like audio, specialized audio, all of those things, hot chimney. Those categories have seen a decent growth. But overall, the mobile phone में last 5 years it is a growth out of, especially after the 4G, 5G rollout. That growth we've not seen in the last 6 months. So that is a little slower compared to what our estimations on mobile as a category would be.
Okay. And that has kind of picked up post Q2. You're saying there's some sign of growth coming back.
Yeah. So now, Diwali usually is a mix of all product categories, and and it had the majority of the new launches during this period as well. So usually mobile sales are driven with a lot of factors, especially new launches, new technology changes, or some new features in the phone. Like AI is a new thing that everybody's talking about now, and AI starting at 30,000-40,000 rupees in a basic phone also has become a good feature for it to sell better. So the adaptation of AI in the coming times, or some better features coming in, will definitely have that improvement in purchase of new devices. So mobile phone as a category runs on two major conditions. One is either a really good feature or a new technology change, or the upgrade cycle has to get better, whereas the upgrade cycle, there might be a little delay, and especially with the premium phones and the better quality of phones, you see the upgrade cycle being a little slower compared to the historic period of 12-14 months. Yeah, it is increased by a little more higher period this time.
Sure, sir. And sir, the second question, is about NCR region versus, Telangana and MP region. I understand there we have, relatively newer stores, and you would expect, to pick up. Any discernible trend change in, say similar 2 to 3 year old store in NCR versus, Telangana and AP region, or is the NCR as a region as profitable as, South region for us?
So right now, firstly, the most important task there was to understand the market and deliver a similar store throughput. So we were quite confident that first we achieve a benchmark of 25-30 crores in year one in the NCR region. That is what we are looking at right now. And the productivity for the first set of few stores that we opened up in the last 24 months or last 18 months, which are mature now, those stores are in line with what we would see in the southern cluster. But Delhi as a whole, as a brand being very new there for us, we wanted to give it a little more time for it to start delivering us the numbers. It will be too high of expectation from our group to understand, within the span of say 3 years or so, we start delivering a similar number that we do in South. Whereas the brand is quite new, the customer preferences are a little different there. So a lot of those things were a learning curve for us in the first 12 months, and we try to fix them and try to go from them. We see a positive growth coming in there. So we will look at a very small base than now that growing at 40, 50, 60%. It's still a smaller number for us. We would like to, create a bigger base in the going time in that region as well, and start dominating that market, at least with a bigger market share than what it is currently at.
Yeah, sure. Thanks.
Thank you.
Thank you very much. Gentle reminder to all participants, you may press star and 1 for questions. We have a question from Rajiv Bharati from Nuvama. Please go ahead.
Yeah, good afternoon, sir. Thanks for the opportunity. So, regarding this North cluster, so for the quarter, we will be having a bit pre-Ind AS loss, right?
Sorry, I didn't get you.
For the quarter, for Q2, at pre-Ind AS level in the North cluster, there should be a loss, right?
Yes, pre-NDS level, exactly right, Rajiv. So there would be a decline in it because when we calculate the EBITDA post-NDS, the interest, the depreciation or the rental would get marked post-EBITDA. So there you would see, a little decline there compared to the previous quarter. But like looking at this quarter, because the productivity also was a little lower compared to the previous quarter of Q1 or the Q4. So then automatically you look at a lower number there. So that is true. What you said is true. But then spanning out for quarter 3, quarter 4, we are in line with our expectation of being positive in that region as well.
So when I compare this against, let's say, your South cluster, where you mentioned that the SSG is in low single digits, there we have still seen, you kind of held ground on the cost of retailing bit, and the margins are largely stable there. So this is, you're saying, purely the rental line item which is eating that. Above that, everything else is.
Rajiv, what happens is that, like for example, there are almost 7-8 properties which are not operational in Delhi as a region, for which we've already capitalized a lot of expenses. Their interest has been booked because we bought these properties out and they're quite expensive properties. So if you calculate करोगे तो उसका cost is higher than the actual operational cost that we're without operation that we are bearing, that cost on the balance sheet with the existing operational stores. So the non-operational stores are also very high in numbers versus the operational stores. So like in Hyderabad or in AP Telangana region, when you open 130, 140 stores, even if 3-4 stores are getting made, the cost doesn't impact our margins drastically. Whereas in the North cluster, the base itself for operational stores is very low versus what is getting under construction today are almost 40% of the same base. So then the cost also gets negated towards the operational stores.
Sure. And this, because your the South cluster is largely static, this 70 basis point drop in gross margin can be purely because of the mix of this North, or let's say in South also we have seen a decline in.
I would not attribute it to North, South or a particular category mix. So if you see, it was a one-time quarter, where you would see that kind of a dip in the GP. Whereas, the product mix more or less was in line what we expected. The mobile phones usually in this quarter go up a little bit. The productivity from other categories were also same. So we did not see, majorly only large appliances like refrigerators and washing machines saw a little degrowth there. But apart from that, not major concern where, we would try to tweak something or, be worried about something. I think it was just one-off quarter where the margin got declined. Actually, if you see the whole half year also, it is down by 0.3, 0.4%. So not much of a concern area as well.
So the only bit is as and when North cluster's proportion increases, the gross margin would not dip. Is it safe to assume that?
Really, because on a 1400 crore base, the contribution from North cluster was only hardly 80 crores. So अगर आप ऐसे देखोगे तो बहुत छोटा contribution है वहाँ पे.
Got it. Yeah. That's all from my side. Thanks a lot.
Thank you very much. We have next question from the line of Omkar Chitnis from Trade Brains Private Limited. Please proceed, sir.
So previously I got disconnected because of network. My question was, how many stores are in profitable as of now?
So Omkar, yeah, so actually I didn't know that your call had dropped. Sorry for that. So Omkar, so if you look at how the stores that we opened in the last 6 months or so, only those stores will be, starting of doing operational break-even. Whereas, your cost for rentals and all would get covered at 4-5% EBITDA margin kind of a thing. But overall, if you see, there are no stores in red. Only one store that we expected it to get in red in the next 12 months or so, which was in a mall because of the rental escalation going up drastically. We had shut that store. Apart from that, no other store of ours is into red where, we are burning money to run that store. So we don't run stores in that manner, so all of our stores are positive. Only Delhi as a cluster or North as a cluster definitely is much lower in terms of profitability today because a lot of other expenses are getting added to that cluster where the base itself is so low. Apart from that, no other store, no other cluster is in red, or I would say that no other cluster is in a worry of our concern where we have to start shutting stores or looking into the profitability of those stores.
Okay. Understood, sir.
Only the margin would differ. Like the mature stores in Hyderabad would give you 8, 9, 10% kind of an EBITDA, for example. The newer stores will start giving you 2, 3, 4%. So, आपका blended would be at 8.5, 8.1, 8.2% kind of a number.
Okay. Sir, as you plan 25-30 stores going ahead, so are you planning for any QIP to fund those stores?
Sorry, can you repeat your question?
As you guided for 20-30 stores for FY25 for going ahead, so are you planning for any QIP for that?
No, nothing of that sort, Omkarji. So right now, with our internal cash flows and the lines of debt available with us, we are quite comfortable for the expansion. There are another 20 odd crores left for our capex money also that we had raised during our IPO back in 22. So that also around 20 odd crores is left with us for our further expansion of capex. So money is there, so no worries on that.
Okay, sir. My last question is, on the slide 6, I saw that there is zero sales from online. From last 2 years, we are not making sale from online. Our competitors are going in online aggressively to tap a smaller market. What is our plan for that, sir?
So, Omkarji, historically also we never were a direct seller for our consumers online as well. We never did sell from our own portal. So what you see online is on the marketplace of Amazon, Flipkart. So usually only when a brand that we sell like a Samsung, LG or a Sony or Apple, whoever it is, if only they authorize us to sell something online, we sell online. So not that we sell online throughout the year or we sell a lot of products. So there are hardly any listings of online category, and that is only after the approvals of the bigger brands. So we do not intend to go online and sell online until they ask us to do that.
Okay, what is about tapping tier 2, tier 3 cities, sir?
Sorry, can you repeat your question? Tier 2?
How are you tapping tier 2, tier 3 cities audience?
Yeah, so with our stores, so definitely our, so if you see our stores, with almost 50% are in tier 2, tier 3 and 4 towns as well. So in a cluster where we are growing right now, we would see good growth coming in from those clusters, but probably a different strategy, little more smaller store size, a little more aggressive or differential marketing there, because not necessarily that print and radio would work in every cluster there as well. So all of those things are taken care of, and we see good demand coming in from those areas as well.
Okay, but as you mentioned, strategy, sir, in the case of exclusive brand outlets, are you going for any ownership and operation model type?
No, sir. So exclusive brand outlets will be only for brands like Samsung, LG, Apple. So only after they would suggest us to open in any of the regions, we would do that. But that is not a key growth strategy for us going forward as well. Probably you might see 1 or 2 stores opening up under the EBO format. Apart from that, we don't intend to open EBO formats at all.
Okay, sir. Thank you, sir.
Thank you, Omkar.
Thank you very much. Participants, if you wish to ask a question, you may now press star and 1. As there are no further questions, I would like to hand the conference over to management for closing comments.
I would like to thank all of you for joining the call. I hope that we were able to answer all your questions. And for any other queries, you may get in touch with us or Mr. Deven Dhruva from HGA. We will be happy to address all your queries. Thank you once again.
On behalf of Electronics Mart India Limited, that concludes this conference call. Thank you for joining us. You may now disconnect your lines.